In this video, we will be looking at our assets. This is a term that is defined in your textbooks as resources that are controlled by the company. And then they say this is because of past events. And then when they talk of past events, they basically referring to the time at which these assets or items were bought. And then the last part of the definition is that they must lead to future economic benefits flowing into the company. So when they talk about these economic benefits, they're basically saying that the assets must make money for the company or must generate profits for the company. So this definition is basically a fancier way of saying assets are things that the company owns or that the company uses to make money. And that is our asset definition. So now that we've looked at the definition, I want us to look at the different types of e-assets that we have, or the classification of assets, right? And there's two of them. So the first one is our non-current assets, right? So these are assets that will be held or used for more than a year after the financial period has ended. So we are looking at a longer period of time. And it's like things like your buildings or your land, your vehicles, the cell phones we use, and laptops, right? In as long as you are going to use it for more than a year. And any money that you've put in aside in your fixed deposits and invested it for longer than a year will be classified as a non-current asset. And then our current assets, it's those assets that will be consumed currently. They will be used within 12 months after the year has ended. And there we are looking at things like your inventory, consumable stores, your debtors, your prepaid expenses, or any money that you have in your bank will be. So all those will be classified and recorded as current assets in our financial statements, right? So now that we've looked at the examples or the classifications of these assets, I now want us to look at the behavior of these assets. And I want to demonstrate the behavior of these assets by use of a ledger account or a T account. So let us look at a ledger account of an asset and see how an asset should be behaving. So right there, we can maybe have our assets, and then our T account can go there. And then we know that in our T account, the left side is the debit side, and then the right side is the credit side. So now, this is a very important thing that we need to make sure that we remember, right? We need to always know that our assets will always increase on the debit side, right? So anything that increases an asset should be recorded on the debit side. And then anything that decreases an asset should be recorded on our credit side. So our decreases would come this side at all instances, right? So now let's look at the types or the example of the transactions we might deal with that might increase our assets, right? So the pretty obvious one is that when we buy assets, so when we buy a new asset, our asset base is going to increase, right? Another one would be when we receive money. So when we receive money, our bank balance is going to increase. When we sell on credit, so when we sell on credit, it means that we have a debtor. Someone owes us money and they have to pay us back our money sometime in the future or give us back our assets, right? Now let's look at the types of transactions that might decrease our assets. Here, any payments that we make reduces our bank balance, so that would decrease our assets. If we sell any assets that we have, that would decrease our assets because of we no longer have that asset with us. And then another type of a transaction here would be when a debtor settles their account. So when someone pays us back their money, debtor settles their account, it means that they no longer owe us and we cannot expect them to pay us back. And then another one would be when someone goes insolvent or when they go broke and can no longer pay us, and then we write them off as bad debts. So this list is not exhaustive. It's just examples of transactions that might come in and out of these accounts here, right? So one important thing before we leave this ledger account is that we need to know that when we are looking at the value of assets, we are looking at a point in time. Is it at the beginning of the year or is it at the end of the year? So you must know that we should always have an opening balance for our assets, and then we should always have a closing balance. And then this closing balance will be carried down to the next period. So we would have our amounts there, and that's how our T account would look like. So the next thing I want us to now look at is what I call a reconciliation of balances. So this is basically a mirror of this T account. It's just us reconciling to know how many or how much assets do we have at year end, right? So same like our T account, our reconciliation would start with our opening balance, balance, right? And then the next thing that we would need to record is our movements, which is whatever happened during the year between the time the year started and the time the year ended. So the types of movements we would see, it's anything that increases our assets. So it's these transactions on the debit side that would go there. And then the second type would be anything that decreases our assets. So it's these transactions on the credit side that would go there. And then here we would record our amount for the increases, for the decreases, and then we would have the amount for the increases there. Then you must always remember that anything that decreases must be a negative balance or must be a negative figure. Then we'd have our opening balance there. So when you take the opening balance, you add your increases, you deduct your decreases, you should then have a closing balance there. And then this is us trying to get the value of the assets at the end of the year. And then we would have our value there, and then we would have our balance of our assets there. So now one thing I want to highlight is this figure here and this one here should always be the same at all times. These two must be equal. Why am I saying that? This is because of this is basically the same thing. It is a mirror of that. So what this reconciliation is trying to achieve is this thing to say, if the year started if I started the year with just one asset only, and then I bought two assets, that means that I have three assets, but then I sold one. So at the end of the year, that means that I only have I only have two assets left, because if I started the year with one, I bought two and then I sold one, and then I should be left with two there. So this here, what we've done here with the assets is basically the same thing we've done with the reconciliation there. I think that is all for our assets, and then I'll see you in the next video.